involved in finance, I would have laughed in your face. I thought I was going to be an engineer, a researcher for the rest of my career. Um, Things changed, got some different opportunities, and now here we are. So we're going to talk a little bit about renewable energy development and how it's financed, given the new rules of the Inflation Reduction Act. To be very frank, we're going to do a lot of talking about solar. That's been the bulk of what we do. Um, these rules also affect wind. We just don't develop wind. And we'll also touch a little bit on energy storage. And yeah, so the introductions have already been made. Just a little bit about Fellowship Energy. We take everything from sustainability planning and implementation to doing development for municipal, C&I, agribusiness, nonprofits, and faith-based organizations. We do development and co-development. And so what that means is that I develop stuff that Fellowship Energy originates directly. And I also work with developers who have originated projects to help them finance and help them get through their development cycle in order to have successful projects. We also own several systems of our own and provide asset management support to other owners who are high net worth individuals. I've tried to break this down into 4 key topics. We're going to spend a lot of time just talking about development. I think that that's really important here. And then we'll talk a little bit about how energy projects are financed currently, or how you can finance them. And then we'll talk about how the IRA has changed renewable energy. And then finally, we'll finish up with new approaches to financing given that IRA. So like I said, we're going to talk a lot about solar. There are 3 key drivers to whether or not a solar project is economically viable. Now, I say economically viable. People invest in solar, buy solar projects for themselves for a number of reasons. Many of them have nothing to do with the money, but many of them are very much driven by the money. Specifically, we're looking at how much can we save, what other incentives we can get. And so when we look at whether or not a system is viable, we're looking at insulation, or the amount of electricity produced by the system, given the amount of sun on the panels, utility savings, and then incentives. And so if you want to have higher insulation, you want to be in places where you have the best sun. So Arizona, Southern California, et cetera, those are going to be really good just from a sun standpoint. But within a specific geography, your insulation is also going to be affected by which way your panels face and how much tilt they have. If there's trees or other obstructions that shade the system, obviously that's going to reduce the production of that system. Your utility savings, I'm sure you guys already know all this, but your utility savings is based on the dollars per kilowatt hour savings generated by the system. Some systems may also lower the demand charges, which are the dollars per kilowatt charges, but we don't usually guarantee that unless we're using other technology that can support it. Because if you have a cloudy day on your highest demand day, you're still paying full price on those demand charges. So the other piece of this is the incentives. So you have federal incentives, you have the ITC, and we're going to talk a lot about the ITC. You've got upfront and ongoing cash incentives, and then you also can get accelerated depreciation. And then some customers may not be able to fully monetize the incentives available, and so this triangle will shift depending on the customer, the location, and the system parameters themselves. One thing that is true around the country is that electric rates are skyrocketing. Until recently, electric prices on average grew somewhere between 2 to 4% a year. They grew with inflation. California has always grown faster than everywhere else. and you can see how much fluctuation California has in its peaks, where you can see the summer and winter are very, very different. Illinois has grown the slowest, approximately at about a 1.5% annually, just given their generation mix. And this is commercial pricing. In hyperinflation in the past few months have caused power prices to go up by 40%. This increase has been mostly driven by the cost of supply due to increased fuel costs. California had two 20% rate hikes in 3 months. And Massachusetts has just announced at the commercial level that they're going to make a jump from a supply cost jump from 15 cents per kilowatt hour to 22 in January, and then another one to 48 cents per kilowatt hour expected in March. And that's not including any of the costs of delivery or anything like that. So electric rates are definitely on the rise. It's sometimes been a question of, do we feel it or not? And people are definitely starting to feel it. To combat these rates, solar allows customers to take control of their electric bill, essentially. We can provide, with the right system, we can provide enough electricity to reduce bills down almost to zero. And systems are expected to last over 25 years at this point. And so the net savings can be extremely significant. But solar production and utility savings will often go hand in hand. And that's through net metering and the ability to export the power back to the grid. And net metering is not necessarily available everywhere. So when a system produces more power than is being used at the load, it's going to inject power into the grid, especially if it's a grid-tied system. A lot of the production of a solar system occurs in the middle of the day, but the consumption of that energy doesn't necessarily occur until either the morning, until the morning or the evening, where the solar is not directly producing. And so net energy metering is a utility billing mechanism that allows customers to get credit for the energy that they inject into the grid. In most cases, it's credited at the retail rate. There are cases where it's not, California is not, and they've had a bunch of different changes to their net metering laws. It's not something we're going to go into in detail here. But a net meter will run backwards and forwards. And what it'll do is at the end of a month, the utility will look at the amount of electricity, the meter reading, and if you've produced more than you've consumed, then you have your production is zeroed, and the remainder is banked to be used at a later date. So especially in the summer, customers will often produce more electricity than they consume, and that overproduction will be banked and used at times, especially in the winter. If you look at the graph on the left, the system is producing the exact same amount of electricity as the customer is consuming, but it's not doing it at the exact same times. So in July and in June, July, and May, the customer is consuming very little electricity, but that's really when the system is producing at its highest. Whereas in December and January, the customer is using a whole lot more electricity, and the electricity that was banked in the months where overproduction was being used will zero out that consumption over time. And so we use that mechanism to size systems and determine, how we're going to provide that value to the customer. So the other piece that we talked about, or I just talked about, is the incentives. And so you can look at the key drivers, as we talked about it, in each of the various solar markets. These are all places where there is a lot of solar or has been a lot of solar. California obviously is the solar capital of the country, just in terms of pure volume. Utility pricing is very high. Their insulation is generally high. All of these systems we're assuming can take advantage of tax credits and depreciation, accelerated depreciation, to help drive losses that are treated as cash when you're offsetting your tax liability. And so that's additional value generated by the system. But the third thing here is the state incentives. So California has none, but because of how high the utility pricing has been and the value of the insulation, solar viability is quite high. Massachusetts is not, Massachusetts, New Jersey are not places you'd expect that you'd have, a lot of solar, but these are two of the biggest per capita markets in the country, with Massachusetts in the #1 spot. And I think New Jersey is currently in #2. It hasn't always been that way. They've been flipped before. But in Massachusetts, the utility pricing is very high. New Jersey, it's somewhere around the middle. Insulation is lower. We're not talking about Maine or parts of Canada, but it's not, we're not talking about California. New Jersey, you're further south, you do get better production overall, but then you look at the state incentives and they're very, very strong. Massachusetts has a Mass Smart, which is $1 per kilowatt hour incentive that has adders depending on for various project locations and types and customer types. Whereas New Jersey has a solar renewable energy credit, or an SREC. We're going to talk about SRECs a bunch, which is a 15-year contract with the New Jersey utilities, where they purchase those SRECs at a fixed rate. And so that adds a lot of value given the rate of the SRECs. And so again, solar viability is very high. Arizona, the utility pricing is actually surprisingly low, but because the insulation is quite high, the viability is really dependent on a lot more on location in Arizona and the system type you're talking about. And then we come to my state, which is Illinois, where we have pretty mid utility pricing. We're a little bit lower than New Jersey, but we're higher than places like Arizona. Our insulation is pretty similar to places like New Jersey. Now, Illinois is actually a surprisingly large state. So up at where I live in the Chicagoland area, production is much lower than when you get down to Southern Illinois, where you're essentially in the middle of the country. And so we do have quite a spread, but what makes our state a little bit interesting is our state incentives. And so solar viability has been quite high. I actually want to talk a little bit about this state incentive because it created an unprecedented boom in Illinois for solar starting in 2017, where the amount of capacity in the state has doubled every single year. And so solar systems generate one renewable energy credit, or one renewable energy certificate, or REC, for every megawatt hour of electricity. And these represent the environmental attributes of the renewable energy. Selling these RECs can help an organization offset their carbon footprint. In this case, we're selling it to the utilities. There are some laws that require them to offset to purchase 25% or more. I think the number is 25% by 2025 of renewable energy in their supply mix, but their supply comes from the ISO, and so it's a mix of any type of electricity that is the cheapest at that exact moment. And so buying these RECs allow them to say, well, we may buy this electricity, but we've also purchased these RECs from these developments to offset those purchases. What makes the market here in Illinois unique is that depending on the system, the utilities are offering 15 or 20-year contracts, and then they pay them at a different rate. So if you've got a small system, these are residential and very small commercial systems, you receive 15 years of REC payments up front. And that's a huge deal because you can see in the table, you can see how high these REC prices are. To get all of that up front drives a lot of value and incentivizes people to buy these systems. When you get into larger systems, so between 25 and 5,000 kilowatts AC that are behind the meter, or if they're community-driven community solar systems, you're getting a 15-year contract, but it's paid over 5 to 6 years. They recently changed this. I don't know if it's gone into effect yet. And then when you have traditional community solar or you're giving it to a public school who needs that spread out over a longer period of time, they're actually given a 20-year contract but those are paid as generated. And so there's benefit to all of these different things. The economics change when you get into these various projects. And so it's really driven the market. In 2017, there were maybe a handful of companies in Illinois. Now there are hundreds of companies doing both residential and commercial solar just in the Illinois area alone. So let's talk a little bit about renewable energy financing mechanisms, because this is also a driver of development, is how are you going to finance this? And so what we talk about is a power purchase agreement, or a PPA. And a PPA is exactly what you have with the utility. You have a contract with the utility that says that when you turn on a light, they're going to provide you the electricity for it, and you're going to pay for that electricity. In the case of a solar system, it's a little bit different. The solar system is going to produce electricity. The customer is going to pay for the power produced by the solar system, whether they use that power at that moment or not. That's called a take or pay contract. And it typically gets invoiced for on a monthly basis for the kilowatt hours generated by the system. So still treated like the utility treats their billing, but if you have a solar system that generates 100,000 kilowatt hours and you only use 90,000 of those kilowatt hours, you're still being charged for the full 100,000. And so it's really important to size your systems appropriately, especially when you have a power purchase agreement involved. Customers often pay $0 upfront for the system, and for the system construction, and then they're charged on a contracted rate that's often lower than their current utility rate. The goal is to provide a customer savings who can't fully monetize the benefits of the system. And so a third party will come in and they'll finance the construction of the system and own and operate that system for the life of the contract. They receive the investment tax credit and the depreciation. They receive any state incentives. They receive the payments from the customer. They're also responsible for paying for the operation and maintenance of the system and paying to insure the system. They also often will do it at a much lower return requirement, which makes these systems viable for the customer. PPAs can often be the answer for commercial customers, where the amount of investment required is fairly sizable, but many times a customer can't monetize all the tax benefits or doesn't have the ability to operate a system themselves, and so that makes more sense for them. So when we're developing, we have to ask ourselves, would third-party ownership or a PPA make sense? And so we go through these deciding factors. The common deciding factors for a PPA are those upfront costs. The contract doesn't sit on their balance sheet the way that debt would. They can't monetize the tax benefits, including the 30% ITC. They lack available internal funding, so they don't, it's a $5 million system and they don't just have that cash on hand. They don't have the ability to operate and maintain the system themselves. Now, solar systems don't take a lot of maintenance, but you do have to keep things maintained to stay within warranties. And so some of that is implied in owning your own system. And more importantly, they're motivated by fixing a portion of their power costs for a long period of time. 20 to 25 years is average. We're seeing power purchase agreements go as far out as 30 years. If the customer might want to own the system if they have limited corporate credit or they're not able to finance via PPA. They have a large tax liability, so big corporations who have the cash on hand may say, you know what, we're going to take the tax credit. They can't get into a long-term contract. We've seen a lot of companies and some of them would surprise you, that their bylaws don't allow them to get into a 25-year contract. The longest they can enter into is a 5 or a 10, and the amount of headache that it takes to make a 10-year power purchase agreement work isn't worth it. And so they just say, we'll just own the system and we'll maximize our benefits that way. Or they have the staff on hand to manage and operate the system who can go through and do, they have electricians on staff or what have you to check the inverters and check the panels and all that stuff. Under a PPA, these systems are owned by long-term asset holders versus obviously a customer-owned system is owned by the customer. And the obligations for the customer who hosts the system. So as you probably figured out, a third-party owned system is hosted by a customer that uses the electricity but does not own their own system. And so the host is, in the case of a third-party owned system, is required to provide access to the site owner, to the sites for the owners. So their maintenance crews to come out to come check on things, et cetera, if they need to do landscaping, if it's a ground-mounted system and all that stuff. And then they're also required to pay their monthly invoices. A customer-owned system, they're required to insure, operate, and maintain sites, coordinate repairs or warranty claims as needed, and manage incentive reporting and payments. Now, some of this can be farmed out. There are companies that all they do is third-party stuff for customers and all that. But on the highest level, there is some responsibility that needs to be taken by customers who own their own systems that is passed on to these long-term asset owners during a third-party owned system. So a lot of what we're going to talk about is third-party ownership because it's a lot of how developers do their business. And so for these third-party owned systems, there are two distinct models. There is the develop and sell, and there's the develop and hold. Develop and sell is we as the developer are going to get this system ready to construct. And in some cases, we'll construct the system all the way to mechanical completion. And then we don't have the tax appetite or the back-end financing to operate the system, or we don't want to operate the system long-term. So we go and we work with a long-term asset owner. We sell them the project as if it's a cash deal. They own the project and they operate it instead. With the develop and hold, we develop the project, we take it all the way through construction, and we operate it on behalf of the customer. Essentially, we are the long-term asset owner and the developer at the same time. This develop and hold model is, if you replace the word developer with long-term asset owner, that's the back end of the develop and sell, just for somebody who's not doing the at-risk development work. So under a develop and sell model, we'll go into a little bit more detail on this. Developers sell projects to long-term asset holders and earn a developer fee. So we make our profit by selling a system. We have a cost to build the system, and we have a cost to sell the system, and we take the spread. We are responsible for all the development costs prior to notice to proceed with construction. So that's the design and layout, the interconnection application, design package, any interconnection application fees, geotechnical testing if it's ground mount, boundary surveys if it's ground mount, environmental assessments, et cetera. All of those are considered at-risk costs, and those are the developer's responsibility. When the developer sells the rights to operate the PPA and they transfer all of the PPA and other project documents to a long-term asset owner, they do so at a fixed price, and the owner will pay what we would call an acquisition price based on their hurdle rate. That's an internal rate of return that they need to have. So they'll model all of the cash flows out and price that to hit a 7 or 8 or 10% return, whatever their hurdle rate is. They pay the acquisition price. The developer pays the EPC price, and EPC is engineering, procurement, and construction. And they pay to have the system constructed, and whatever's left over is what the developer earns. The developer doesn't retain any ownership of the project, and they don't receive any cash flows from the project long term. The other model is a developer acquires the customer same way as they would normally. They are responsible for everything prior to notice to proceed. The developer pays the EPC to build the system, and in some cases, the developer may pay EPC to do some of those pre-notice to proceed development activities as part of their EPC price. But either way, it's all at risk. And then the developer earns their return based on the cash flows from operating the systems. They have monetized the ITC and the depreciation. They keep any incentives associated with the system, and they receive all the revenue and pay for the operating expenses. The developers in this case, they don't take a direct developer fee, but instead they earn a higher return than a long-term asset owner who's acquiring a system. The asset owner will pay the market a specific price based on a specific return, which is a market price for a fully developed project, and the developer that sells the project earns the difference between the cost to build the project and the market price. I've now said that a whole bunch, but that's really important, is that spread is what makes a developer their money. And then a developer who holds a project will invest the project cost, which is the market price less what the developer fee, and earn the same cash flows as the investor, giving them a higher overall return on the system because they've paid less for that same system. So this develop and hold is really what we're going to start talking about further when we start talking about financing mechanisms. So on the back end of this gets a little bit complicated. So I'm going to try to keep it at as high of a level as possible. Currently, there are tax investors, and then there are sponsors. Sponsors are the developers or the long-term asset owners who hold the system. But in some cases, the sponsors don't have the tax liability to offset all the tax credits. You build a $100 million system, you're getting $30 million of tax credits. There are very few developers out there who are going to be able to monetize $30 million worth of tax credits. And so they bring in a tax equity investor. Tax equity investor is literally a partner in the system. They are equity. They have upside and downside risk, who invest mostly to receive tax benefits. They enter into these partnerships, and they're able to use U.S. partnership law to their advantage, because U.S. partnership law is extremely flexible, and you can essentially structure a deal in an infinite number of ways, but only if it's a true partnership. And what that means is that tax and cash items can be allocated separately, but some amount of each has to go to each partner, and the structure must allow the tax equity partner, who's going to get mostly tax items and very little cash, to have some substantial amount of risk if the system doesn't perform as well as it should, that they're not just getting tax credit. And the partnership structure is the standard structure for most tax equity at this point, because it has the most backing in law, and because the most tax benefits are monetized in this structure. Tax credits can be allocated to a partner, but the partnership and the partnership allocations must be respected by the IRS. What that means is that you have to show substantial economic effect, and if the partnership allocations are not respected, the tax equity's contribution will be treated as a loan, and tax equity is no longer eligible to receive its share of the ITC. So you really have to be careful as to how you structure it, because you want to ensure that everybody has some risk. You can de-risk a project so much that it's no longer a partnership. It's dead. And so the goal of any of these partnerships is to balance out the risk and the reward. And so the goal is capital efficiency. The partnership will allocate as much of the tax benefit as possible to the investor, while giving as much cash as possible to the sponsor. In most cases, tax equity receives 99% of the tax credit, while the sponsor receives 1%. Tax equity will generally receive at least 5% of operating cash, or what we're seeing a lot is a 2% preferred return of capital contributed while the sponsor receives the rest. What that means is if you contribute $1 million on an annual basis, you'll get 2% of that. You'll get $20,000 a year in cash until they're out of the deal. That's 2% pref on the deal. So when we talk about allocating tax and cash separately, we really mean it. Cash and revenue is actual cash that can be taken out of the partnership, whereas income and loss are what really determine the amount of taxes paid for that year. And so we have to understand that cash is entirely different, though related to income and loss. Cash, income and loss includes your depreciation, your amortization, your interest, and in order to determine your taxable income, whereas your cash is really your revenue in minus your operating expenses out. And so we allocate those separately to help be more efficient with the way the partnership works. The cash items will include PPA payments, cash incentives, and then operating expenses are included in that. Tax items include tax credits, depreciation, interest, amortization. And then in the context of tax equity partnerships, losses or paying less tax is good, and income or paying more tax is bad, because the whole goal of the tax equity investor is to reduce their tax liability for as long as possible. And so the allocations end up being heavily weighted towards tax, especially initially, where you can get 99% of the ITC, which is the major part of their return, 99% of income and loss. Tax equity has to receive some cash, and I've said this a number of times, but this is so important that under a tax equity, under a partnership, you do have to have some upside or downside risk. Now we'll talk about this under a different guise when we get to the IRA, because this changes a little bit, but it's important to understand what today looks like and then what the future will look like. And so there's actually specific requirements to be met, and then all of those allocations can flip, if you will. And so generally speaking, tax equity allocations flip down to a reduced amount of both tax and cash, either after a specific number of months for a fixed flip, or when tax equity reaches a specific return, which is a yield-based flip. Fixed flip structures allow tax equity to achieve their target return if the system behaves as expected. A yield-based flip allows them to retrieve its target IRR before the flip date, but system performance will affect whether or not that flip occurs when it's expected to, or later or earlier. And so you have to balance some of this stuff out, and a flip can't occur until after the ITC has fully vested. So what that means is every year, part of the ITC will vest, which means that if you have a recapture event, that you only have to pay back so much of that ITC back to the IRS. And so if you look at this chart here, we have what's called the recapture period, which is, and the initial period is the first year usually, and then the recapture period is the remaining 4 years of the recapture period. But the goal is to keep your allocations as standard as possible throughout those periods. And then once you get out of the recapture period, you can adjust them again, but you have to maintain under certain rules. Now, in this chart, there is a nuance in here, this 67%. We're not really going to go into it, but there is an amount of allocation change you can do in the recapture period. We're not seeing it anymore. It was very complicated from a tax standpoint, and so a lot of the tax investors have really stayed away from it. But as long as tax equity is staying in the deal throughout the recapture period, either type of flip will work. Some will have a minimum to stay in, and then exit mechanisms will kick in. Others will stay in longer just to ensure that they've achieved a certain return. But either way, when that flip occurs, when the condition to cause the partnership allocations to flip occurs, tax equity ends up going from receiving a certain amount of cash and tax to receiving very little cash and tax. And the goal here is to incentivize the sponsor to buy out tax equity's position in the partnership. Debt can also be added to these partnerships. So tax equity is going to come in and be about 40 or 50% of the project. The rest of that cost is often paid for using a loan. And we can make these loans non-recourse, which means that you are not personally responsible as either a company or as an individual by using special use LLCs or limited liability companies that allow cash from the project to be the collateral for the debt. So a special purpose vehicle or special purpose entity, or an SPV or SPE, some people call it one or the other, are companies that are designed to house just the project holdings. They're widely used in project finance, typically in the form of an LLC. They're legally independent subsidiaries that serve specific economic goals of the parent company and are fully liable for the debts of the project. But the debt is taken on the fact that those project companies hold a contract that requires a customer to pay a certain amount of cash and have contracts for the operating expenses as well. And so what that allows them to do is that they can tie that debt to the cash flows of the project, and they will come into the project and be able to be the debt that is based on project cash flows. In the event that the parent company goes out of business, the debt can come in and take over that project and operate it to pay back their debt service at the very least. Debt can come before or after commercial operation and has a bunch of different forms and requirements. Our pre-commercial operation date capital stack consists of construction debt and potentially a tax equity bridge loan and equity. And then when you near COD or get to COD, any pre-commercial operation debt will convert to the term debt, and then tax equity will put in their capital to take out any of the tax equity bridge loans you might have. If the project ownership defaults, and I said this before, but this is important for how non-recourse debt works. If the project ownership defaults, debt can step in and they can receive the debt service to pay down their loan. That should also allow them to turn around and sell the project to another owner who could step into the debt as well. Debt can come in two different places, but tax equity often prefers to keep them out of the partnership. Tax equity and debt are constantly in a fight for seniority. Who gets paid first? Who has less risk? Project level debt comes in at the same place as tax equity, and so if you put the debt in at the project level, you'll have to have the debt sign a forbearance agreement, which essentially says we're not going to turn off the system during the recapture period, because if we did, we would just completely erode tax equity's return. Back leverage debt is more palatable for tax equity and is always junior to the tax equity. And so you're in your capital, in your waterfall of cash, tax equity gets paid first, the sponsor gets paid second, and of the cash that goes to the sponsor, some of that goes back to the debt provider as payment for their debt service. Sizing's done the same way, so it's really just a risk profile thing for tax equity and what it does inside of the partnership. And what's cool about debt for solar deals, and this is why we're talking a lot about it, is that they're sculpted to the cash flows. A lot of solar deals will have escalators on the PPA, so a 2% escalator means that you're going to have more cash coming in in the back end of the contract than you did at the beginning. And so rather than saying, okay, well, we're going to give you $1 million and you're going to pay 5% interest on that, and you're going to pay it over 20 years, and you're going to have a fixed debt service payment each year, et cetera, they say, if we were to fix the debt service coverage ratio, the debt service coverage ratio is the difference between the interest and principal of the debt and the amount of cash coming out of the system. You can see that depicted here at, let's call it 1.25 over the period that we're going to give the debt for. How much will we give if we have an interest rate of X? And so they take the net present value of the cash flows and at the 5% interest rate, and that gets you the total amount of cash given. In this case, in the example, it's going to be $62 million of debt, and then that plus the tax equity, that'll get you to your total amount of investment. And you can see that the debt service here is taking into account the tax equity payments in the first 5 years because tax equity is senior to the debt. So now that we've talked about that, and now that we've gone into painfully more detail about finance than any of you probably were imagining you'd be talking about today, let's talk about this new bill. So the Inflation Reduction Act, and we'll call it the IRA, which, while unfortunate, is a much easier acronym to work with than Inflation Reduction Act all the time. It establishes new baselines for the tax credits and creates new credits for different asset types. It created adders for the tax credits, and it also created some new provisions on how that payment works. So before now, the way that this was structured was it was a 30% tax credit that sunsets down to 26%, sunsets down to 22%. Going into 2023, we were expecting to have a 22% ITC. In 2022, it was at 26%. And before that, it was sitting at 30%. What they've done is they've taken that base tax credit and they've reduced it to 6%. However, if the system is built with prevailing wage and meets the 10% apprenticeship requirement, that gets a 5x multiplier. So it goes back up to 30%. The goal here is to incentivize people to pay the laborers building the system a good wage. This is most of the construction is not skilled labor, but it is important labor, and the government was trying to make sure that these laborers are getting paid, the prevailing wage. On systems smaller than 1 megawatt AC, you don't need to have these requirements for it to get the 5x multiplier. A lot of times when you're smaller than a megawatt, the cost of the system really becomes a factor, and adding cost by having prevailing wage could disincentivize the building of smaller distributed solar assets, and so they've waived that for those smaller systems. There is an ITC and a PTC, a production tax credit, and an investment tax credit. Production tax credit is paid over time based on the production of the system. That's usually used for wind systems, where they produce a lot more than they cost in terms of a ratio. But for solar, the ITC is generally more lucrative for the developers because the cost of solar versus the amount of production, it just weights more in the ITC's favor. The adders are available for specific types of projects. We'll go into it in more detail in a little bit, but those adders are solar for low-income communities, solar on tribal lands, low-income communities serving residential customers, and there's some nuance to that we'll go into, energy communities, and then domestic product. What also happened was that tax-exempt organizations, or TEOs, are able to get the ITC paid in cash, if you will. The IRA allows the ITC to be treated as a rebate, and the IRS will treat the tax credit as an overpayment of the organization's taxes, which are zero, and send a refund check. Now, I'm going to caveat this whole section that none of the guidance on this has come out, and we're expecting it in mid-February. So this is what we know as of today. Both taxable organizations and tax exempt organizations can also use the tax credit transfer provisions that were written into the IRA to sell their tax credits if they can't monetize them themselves. So where I just talked about how tax equity, they can't just buy tax credits, that is changing. And so we're going to see new financing structures with that. So this is a very busy slide. We're going to get into this one by one, but these 10% adders are, as far as we understand them, are stackable, but each of them has their own set of rules that govern eligibility and are only available for certain types of projects. Our tribal adder, low-income community adder, low-income community serving residential customer, and energy community are all limited to 5 megawatts AC. For the tribal, low-income, and energy communities, they need to be located in a tribal, on tribal land or in a qualified census tract for a low-income community, or in an energy community, which has its own set of definitions that are a little complicated. But then if you have a low-income community project that is also serving low-income residential customers, there are opportunities for another 10% on top of that. These adders are stackable as far as we know. So in the right location with the right customers and using the right products, a project could be worth as much as 70% ITC, which that then starts to beg some questions about who retains that value. Is it the customers who are getting that value? Is it the developers who are getting that value? Is it the financiers? Is it a little bit of everything? And it allows us to incentivize development in places where it wasn't necessarily possible. And as you can see, I am also caveating all of this with the expected guidance is coming in the middle of February on how these adders are going to be included. We know that there's interpretation that needs to be done. We know that these programs are going to be built around specific things, but we just don't know the details. And so everybody is trying to position themselves in a way that allows them to best use the tax credits and get themselves in a place where they can make an impact. So there's some decision trees that we can go through to help figure out if we qualify for a 10% adder or a 20% adder. And you start out with, is the project less than 5 megawatts AC? No, you get no adders. Yes, then you ask yourself, is it in a qualified census tract or on tribal land? If it's not, then you get no adder. If it is, then you go to the next place. Is it sited on a low-income residential building or not? And if the answer is no, then you have to ask, does it serve at least 50% of the value go to low-income residential customers? Now, you can see that this extra 10% goes for both the tribal and the low-income. There is that in the laws that is written into the provision. And so if it's not providing value to low-income residential customers, then you're just getting the 10% adder. If it does, then you get the 20%. If it was sited on a low-income residential building and it's serving low-income residential customers, then you're getting the 20% adder. So this is the type of decision tree that developers are going to have to go through to really understand what they're getting on the ITC. The energy community adder is a little bit more complicated. We start with our 5 megawatts. We ask, is it located on a brownfield site? If it is, automatic 10. If it's not, we ask, is it located in a community that with 0.17% employment in fossil fuels? If it is, again, automatic 10. If not, we go to the next one. Is it in a census tract with a coal mine that closed prior to 1999? You know the drill. If it is, you get the 10. If not, you go to the next one, where is it in a census tract with a coal-fired power plant that closed prior to 2009? And again, if it is 10%, if not, it doesn't qualify. And so we go through this decision tree for every site because we're trying to maximize the value across the board. Now, what's really cool about this is that it opens up some new states for development. States in the South are going to have a lot of new development. States in the upper central, I wouldn't even know what you would call Montana, North Dakota, South Dakota, Nebraska, et cetera, where you can see that state solar capacity in these areas have been really limited, and yet there are plenty of low-income communities, but especially in the Arkansas and Mississippi area, where the average median income is less than $45,000. And when you start to add in the estimate of where the energy communities are, you're going to see Montana's just filled with this. Wyoming is filled with these energy communities. Pennsylvania has a lot of that. Then you layer these on together with the low income communities, and you see some of these areas that are all green all through Pennsylvania, West Virginia, Kentucky, parts of Texas. These are overlapping census tracts. These are going to be 20% or 30% adders if those states have community solar laws. So maps like this, these are very general and estimated, but maps like this are going to be more powerful for developers as we go to figure out where we can develop to really have an impact. And it's going to open up major states like you can see in South Carolina, Georgia, North Carolina, areas where there's not a lot of solar. Now you can get at least the 10% for low-income census tracts. The last one is domestic product. It's extremely simple, but I think it's going to be the most difficult to achieve, just given the fact that manufacturing is really happening in Asia right now, and we're starting to see panels come into the U.S., but not at any huge level. I think that over the next 2 years, it's going to change because there are incentives for them to come back to the U.S. But you have to go through the same tree. Is 100% of the steel coming from U.S. manufacturers? Yes. Okay. Did 100% of the iron come from U.S. manufacturers? Yes. Great. Now, does 40% of the equipment value come from U.S. manufacturers? If the answer is yes, you get your 10%. If the answer to any of these are no, which right now, a lot of these are going to be no right now, you won't get the adder. And then the big one that's affecting us the most, and this is an extremely busy slide, but let's just go into it, is that the tax-exempt organizations who have traditionally not had access to the ITC now get access to the ITC, and it allows them to take advantage and have their own ownership. Previously, they were required to go through third-party ownership, and now they have options. Okay, so let's get into the final piece of this, which is how does direct pay affect the financing of this? So we have an additional 30% or more value than they did for tax-exempt organizations before the IRA. So if you wanted to buy a system, you could. If your local church or the state government wanted to buy a system, they could. But it's worth only the cash flows of the system. Now, under the IRA, it's now got a 30% at least additional value in the form of the ITC because it can be treated as cash. You don't necessarily have to have third-party ownership. And now you can just finance the whole thing with debt. It's a lot easier to take out a loan. It's a lot simpler to take out a loan. Most people have taken out a loan for their business or their nonprofit or their synagogue or church, or state governments, municipal governments take out loans all the time. They issue bonds, et cetera. And you can now have a debt-based market. Really valuable. The tax credit transfer, this is what's really interesting for us now, allows tax credits to be sold directly to a tax investor rather than requiring equity ownership. So now you can have, under a power purchase agreement, you've got your tax investor who you're just selling your tax credit to, your debt who's going to size against those cash flows, and you, in the first 5 years where it makes the biggest difference, you get an extra chunk of cash back, and so you can have the whole project, this same whole power purchase agreement, financed in a totally different way. The other interesting thing is that customer financing may be treated differently. Let's say that a corporate can't use the tax benefits, but the developer could. The developer could buy the tax credits back or sell the system to the customer and buy the tax credit back, essentially reducing the cost of the system to the customer. And then the developer would take the tax credits and the customer would get the rest of the value. Or they bring in an external tax investor who can help support that, and the customer is responsible for the remaining value. Where it gets really interesting, and actually I had a phone call about this today, is the possibility of what I would call a tax-advantaged debt. The hard part with any of these tax structures, especially the one with customer financing, is when you have a tax investor to an external investor, you still have a 5-year recapture period. And so how do we deal with that when the investor is not really involved in the deal? There are indemnities that have to be made. We have to protect that tax investor because they're not included in the operation of the system. And so if something goes wrong and there's a recapture event, that's going back to them. In the tax equity investor, with the tax equity investor, it's an active investor in the deal and can make corrective actions to avoid recapture, or has a contract that they're financing against that has provisions in case of that recapture. With the tax credit transfer, that active participation would require us to build in recapture penalties into an agreement that would be serviced for 5 years. So one thing that we could do is we can do tax advantage debt, where we have in this case, we have a 1.2% interest rate on a debt investment of 80% of the value of a project, of $1 million project, and we receive the ITC, and the debt's going to receive a 6%, just above a 6% return, which when you have debt, right now the interest rates are around 5%, 4.5% to 5% for most solar debt. And so this is better, but it's also significantly less costly than what we're seeing in terms of tax equity and debt. And so this opens the door for new financing mechanisms. This could be a really big part of the industry. I'll be excited to see what happens over the next year or two as we go. And hopefully we'll see new mechanisms that allow for different organizations to get into the investing of solar projects, and make new ways to do business, because that's what drives this industry. So I'm going to stop there. I'm going to leave it at that. I don't have any other slides to go through, and I'm going to open it up to questions.
Excellent presentation here, Micah. I'm sure there's a whole bunch of questions, but I wanted to, as I mentioned before, I would like to open the floor to students with questions. Why don't you guys go first? Please unmute yourself, introduce yourself, and ask a question. And I think there's some very interesting things that Micah has gone over. So please go ahead, students.
Hi, Dr. Sussman. Hi, I'm Ava Hudson. I'm in the ESE program. This is my first semester. So I had a question. I was working at Black Hills Energy in South Dakota over the summer, and I was talking to, I believe he was the director of generation or something, and he was saying that one of their issues they're having with not pushing for having customers install solar and such was that there was something with like fixed costs and customers who installed solar and it was reducing their own bill to a certain extent. Other customers ended up carrying some sort of extra charges or carrying like extra costs because of that offset cost. And so my background is not in finance. I don't know all the exact terms that he was using.
No, it's okay.
but I didn't know if that was an issue that you've run into, or if that is just, their own company's issue, or what advice or solutions you had for that.
I am going to go out on a limb and say that we have run into this sometimes, but I think what you're talking about is a company issue. There are fixed costs on electric bills. I don't know if you've ever gone through your electric bill. There are fixed costs. I go through mine out every month because I'm an energy nerd and I'm optimizing my energy costs. But even on our bills, you can reduce your electricity to zero and you still carry some fixed charges. Let's talk residential because it's the simplest. You have $1 per kilowatt charge, and then you have some fixed charges for being a customer and for having a meter. You're renting the meter from the utility. Now, if I were to zero out my bill, I still have about $11 a month in fixed charges. Now, it could be, and let's say it's not a utility issue. It could be that the developer of those systems had no clue that there would still be fixed charges, and they did, and they just said, well, we'll take the total amount that you paid divided by the amount that you used, and that's your offset. That's just bad developing. We always want to look at the individual pieces and figure out what is going to remain and what's not. It's why when I talked about here, that we talk about the $1 per kilowatt hour savings and not the demand charges. And I always say to people, your avoided cost of power from the solar system can only be on that $1 per kilowatt hour charge, because you can't guarantee, well, you can't guarantee anything, but you have no idea when the sun's going to come out, and the system may not offset any of the demand charges. You know that the system will offset the consumption charges, the volumetric charges, but you don't know what the capacity charges are going to look like. Now, if you add storage to the solar system, that's where you start to have some of that. And I don't even remember when it was. It was early on when storage was starting to be paired with solar. I did a paper on this where we talked about how 1 + 1 = 3, where on their own, solar can do some reduction on its own, storage can do some management. But when you pair them together, now you start to ensure solar's ability to reduce demand charges. You have the ability to further discharge and shave off the shoulders that occur when you're coming out of your export period. And so you can really do a lot more together. That's when we start to say, yeah, let's include those demand charges in the economics of the solar.
Thank you very much.
Very good. Questions from students? Unmute yourself, introduce yourself, and ask a question, please.
Hi, my name is Alexander Gardner. I'm another student in the ESE program. Thank you for your talk. That was really cool. I was wondering if you could, I guess, kind of restate maybe the purpose of the tax investor, because the way I understood it, I just didn't understand what they're getting from it. Like they're investing in these projects so that they get the investment tax credits and they get money off their investment, but then do they then have like equity in the, I guess, like the solar farm or whatever it is, and are they taking profits from that?
Yeah.
Like what is their incentive to do that?
Yeah, that's a good question. And this is why tax equity is the most esoteric of all the financing mechanisms. So a tax investor is going to come in and they're going to invest on a multiple of the tax credit. So if you've got a $100 million system and you've got a, let's call it a 30% ITC, you're going to have a $30 million tax credit. And tax equity is going to come in at 1.1. That would be very low, but it comes in at 1.1 of the tax credit. So they're going to come in at $33 million, right? And so if they just received the tax credit, then they would be losing $3 million on their investment. And so part of the way that these partnerships work is there is some cash to get them the rest of their investment. Now, they also receive depreciation. So those losses that come in the first few years. You use accelerated depreciation, which generates losses in the first few years, rather than spreading it out over the life of the system, because it also incentivizes the development of these solar systems. But they get 99% of those losses as well. So that will drive their their return. And then finally, they have a cash piece, which that's the risk, right? Because tax credits and depreciation are guaranteed. You install a system, they are eligible for these things. Operating the system and generating the cash, that's where the risk comes in. And so they have a cash return as well for a very short period of time. Tax equity doesn't want to be in the deal for the whole time. They want to be in for a short period of time and get out. So they build their return off of the tax items, a small amount for the cash, but at the end of the day, their risk and their upside and their downside risk is from the cash, and that gets them the rest of their return. Because nobody is doing this to break even. They want to make money. I'm currently working on a project where the return is somewhere between, for tax equity, is somewhere between 13 and 15%. A lot of that is driven by tax credit and depreciation. It goes back to, if we can do something like a tax advantage debt where the return is 6%, that's significantly less costly to the project. But at the same time, the tax investment is, you're mostly just giving up stuff that's not cash. So you can't use it anyway, you give it up. But yeah, no, there is a cash portion to their return, and it does drive a lot of that.
That makes sense. Thank you.
Yeah, absolutely.
Question for Micah from students. Please raise your hand or ask a question. All right.
That should have a lot of the same.
I've got a question.
Aspects. So
I wanted to know if fellowship energy.
Do I hear two people talking? Hold on.
Chrissy mentioned closed loop control, but we could also disable that for control, especially during and we've got a hand switch on that as well. Where it starts.
Who is talking?
Yeah, I'm sorry.
I believe it was Hal. I just moved him to the waiting room because that's the only person that was
All right.
unmuted. Go ahead, Jose. I think you were the one that was trying to ask.
Jose, was it you who was asking the question? Please go ahead. No? All right, any questions from students for Micah? All right, I want to open the floor to the general audience. Please unmute yourself and introduce yourself and ask a question, please.
Rudy, I have a question. This is Hal.
Okay, Hal, go ahead.
Just a simple one. For a homeowner, I'm getting people who come to my door all the time say that they will install a system, and for a homeowner who isn't sophisticated in all this, seems pretty complicated, and you're not sure what to do to how do you evaluate all the different possibilities for going into a solar system, say for your house?
Excellent
Yeah, it's a
question.
good
Hal.
question. It's the same problem that everybody has, whether you're a homeowner, a business owner, a municipality, anybody who is looking at solar has to ask themselves a number of questions. I would love to say that in my experience, residential solar is all about doing something good for the environment. When I was in management consulting, we once did some primary research on customers, and it was overwhelmingly, I went solar so I could save money on my electric bill. When you're looking at any of this stuff, you want to look at it. You have the emotional side of it, which is we want the sustainability, we want to do well for the environment. Those are intangibles, and we make a decision whether we want to do that or not. Is that important to us? Is it not important to us? Clearly, if you're thinking about going solar, it's probably important for you. This isn't just an economic play. But when you're looking at how is this being evaluated, how am I going to evaluate if I'm getting A, a good price, or B, a good deal, we go back to this triangle, right? So you're going to have somebody come to your house and say, hey, you know, you're going to save $100 a month on your electric bill, and you're going to get this massive ITC and all that stuff. You can break it down into pieces and you can say, okay, what is it that you're saying this is going to be priced at? And then if you know, let's say it's a $100,000 system, then you know right off the bat that you're going to get a $30,000 tax credit. Then you have to ask yourself, how much am I going to save on an annual basis? And then you're going to ask yourself, are there other incentives available that are going to add value to this as well? When I put something in front of a customer, I will put together a pro forma cash flows for their system that shows, here's what we're charging, here's the incentives you're going to get, here are, you know, both the federal tax incentives and the state incentives that are available, and then here is your utility savings. What I'll also do, which not everybody does, is I'll also show the production, the expected production over the period of time in an annual basis, and the expected change in utility rates. The idea being that you give them the information so that they can see this. Now, with a commercial customer, which is what we focus on, and I use commercial as a catch-all for non-residential, it's very much a, what is my return on investment and my IRR on this project? Because this is also an investment in their business. For a residential customer, having been in the residential industry as well, a lot of it is, am I going to be saving money? And am I going to be, is my system going to pay itself back in a reasonable amount of time? Now, panels are now 25-year warranty. So we'll use a 25-year life because we know that that's warranted by the company. If your system is going to take 20 of those 25 years to pay itself back, that's a bad deal. If your system's going to take 5 years of those 25 years, it's probably a good deal. Where it gets hard is where you're somewhere in the middle. That ends up being an individual decision. I've had people say, you know what, 12-year payback, we're good with that. We're going to be in this building forever. And they go for it. I've had people say 10-year payback, that's way too long. I don't want to deal with that. So all of those things go into play. But if you arm yourself with, how should I view this? What's important to me as a homeowner? That's what's really important.
Will the IRA, I know it's going to help a lot of things here, but does it also help the residential customers?
The IRA helps residential customers by giving them an automatic 30% ITC. I don't know if the adders are available for residential customers.
Okay.
It hasn't, honestly, I haven't been in residential in a while, so it just hasn't been on my radar, but it is something that it'll be worth looking into when we get to the middle of February. We'll know all of that stuff by the middle of February.
Thanks.
Yep.
Okay, I see Jose has got his hands raised. Jose, please unmute yourself and ask a question.
Sure.
This line here.
Hi, thank you, Rudy. I wanted to ask Mr. Sussman if Fellowship Energy focuses exclusively on PPAs for solar project applications, or have they looked at other clean energy avenues for funding projects?
Good question.
So to date, we have focused on solar. We do solar and storage. We do include energy efficiency. We have other agreements that we use for those things. We've avoided wind. Wind is an interesting industry. These are big fields. You know, the smallest one I've ever seen is like 50 megawatts. It's a long development cycle. It takes a lot of capital. And oftentimes it's not the kind of industry you can just enter into. Solar has always been a simpler path for most people. And it's got a much more distributed end to it. You don't see a whole lot of distributed wind. It exists, just there isn't a lot of it. But what I would say is that when we start to tie in other assets, specifically storage, because batteries are a big thing right now. When we start to tie in other assets, we either will change the agreement type, or we have to treat those assets in a different way than we would the solar. So for example, if you've got solar and storage, you've got an asset that generates electricity and an asset that transfers electricity. So you're not going to treat the power purchase agreement with a performance aspect for the storage. Rather, you might say, we're going to guarantee some amount of uptime of the system, and we'll be able to track that and ensure that it's operating correctly. Otherwise, you can also use an energy services agreement where, rather than having it having the pricing track on a dollars per kilowatt hour basis, you have a fixed price, and then you have a true up on the back end for over or underperformance of the solar piece of this. And that way you can add more energy assets in. Potentially you could add in energy efficiency and EV charging, and then you just separate those out on the back end for their various ITCs.
Thank you.
I see that Larry, you have your hands raised. Please unmute yourself. Ask your question, sir.
I do. Thank you, Rudy. Micah, glad to see an alum come back as an advisor to the ESE program. Great perspective. Thank you. Question for you that I'm seeing as a structure change to the IRA is that not-for-profits can receive the federal incentive directly. Are you seeing that come to light?
Yeah. It was this giant slide that I felt that I shouldn't, this one, that I shouldn't go and read through the whole thing. This was a big one, actually, especially for us at Fellowship Energy. We've had some dealings with faith-based communities. We've done a lot of work with the faith-based communities in a variety of different areas, and coming back to them and being able to say, hey guys, where we haven't been able to make a PPA work for you, potentially you can own your own system. That's a big deal. I had a portfolio in Arizona that just didn't work because the systems were too small for a power purchase agreement, which does have a lot of fixed cost to it. You have a bunch of lawyers you have to pay a lot of money to, let's be honest. But then we said, well, what if we tried to do it under a capital lease or a debt structure, and we forego the ITC altogether? And again, it didn't really pencil unless they were, and it got close with some of them, but it wasn't right there. Now we have an opportunity to go back to that portfolio and say, hey guys, we might have an opportunity for you by having debt instead of for both the ITC and for the system itself, and now you have an opportunity to own. And so the way that we've been using that in our structures is that we've said, essentially there's two loans. There's a bridge loan for some amount of the ITC. So if you're going to get a 30% ITC, maybe we put 95% of the ITC on a bridge loan, and let's assume a 5% interest rate. So when the ITC comes in, you pay all of that towards the debt, and that covers almost 30% of the value of the system. And then you do a term loan on the remaining value of the system for 15, 20 years, whatever the term loan is. And now you can make systems more viable because you're basing it off of the savings that the customer is going to receive, rather than trying to give them a small amount of savings and then you have to reduce that by operating expenses. And so it's a much more efficient way to finance projects, is directly with a customer.
When you
So
say
I think we're going to
more,
see a lot of that across the board.
when you say more efficient, lower cost of funds, and in effect, full use of the ITC rather than a discounted view by the time it goes through the special purpose entity, the effective value of the ITC might be down to 20%, maybe even 15%. after it gets converted, so to speak?
No, the ITC still has its value. Where the difference between a power purchase agreement and a direct sale comes into play is, let's say your customer savings on the system is $1,000 a year. That's going to be $1,000 a year whether you finance it with debt, cash, or a power purchase agreement. That savings is a direct savings to the customer. The difference is that with a power purchase agreement, we are going to finance at, let's say we give 10% savings. So $900 of that $1,000 is going to come back to the owner of the system, the investor. And so right off the bat, the amount of revenue to the owner of the system is lower than if the customer owned it themselves. Then on top of that, you have to reduce that revenue by the operating expenses. Now, some of those operating expenses may be the same, you know, if you have a maintenance package or what have you, but you also have to insure the system, and you have to manage the system, have an asset manager on the system. And so those are additional costs to the asset owner. The customer themselves would insure the system if they owned it, but usually it's a rider on their insurance and it's a lot less costly. And so at the end of the day, a power purchase agreement is a lot less efficient of an agreement than just a purchase agreement, because you're not able to, you're not getting all of the value off of the system, because you have to be able to provide some value back to the customer.
Yeah.
One of
and I
the
was
things
just
that
trying-
helps in that direction is that the cost of the hurdle rate for the investor is going to be surprisingly lower than not surprisingly, it'll be significantly lower than the hurdle rate for the customer. A lot of customers may want to see a 10 or 12% return on their investment, whereas these investors are taking a 7 or 8% return. And so all of that is to say that there are multiple dynamics there. The back end financing is a whole other piece of it.
Thank you.
All right, I see Matt Crochelle has his hand raised. Hey, Matt, please go ahead.
Yeah, hi, Matt Grossel here. Was in corporate PPAs for a little while. Mike, I actually think we probably had a couple classes together back in like 15 years ago.
Maybe.
I was wondering, I know inflation has been pushing these PPA prices through the roof. Do you see the kind of results of this IRA leveling out costs, bringing them down at all? I mean, are you modeling and seeing any of that? Whether they're like stabilizing, coming down, still creeping up?
Yeah. So interestingly enough, where we're seeing these things have an effect is on the developer fees. A lot of the time we're giving a 10%, 15% savings to a customer. And so maybe we've been going to the lower end of that, going to the 10% instead of the 15, where we're dealing with these things. But what we're seeing is that the escalators on the PPAs are staying the same. People want that 2% or less escalator. And instead, when we're modeling it out, we're putting higher escalators on our operating expenses, on operations and maintenance. Everything used to be a 2% escalator. Oh, we've got an O&M contract, we're going to toss a 2% escalator on it, and it's fine. Now we're seeing people use 3.5% escalators on these things, assuming that this will stabilize out again, and that we're spreading that escalation over the course of the contract. But they're also sticking that on their insurance, on their asset management, because asset management is an internal cost. It's a person cost. So if cost of living is going to increase at a rate of 3 or 3.5% for the next few years, rather than the 2% that you and I have always been used to, then all of that factors in. And so what we're seeing is that the long-term asset owners that we're working with are changing the way they're modeling and adding in 3% escalators to things. They're putting in larger reserves because they're not sure what pricing is going to look like in the future. And so where it's affecting it is on the acquisition prices. We're also seeing EPC prices go up because everybody is trying to do A, prevailing wage, and B, their costs have gone up. And so it's getting kind of squeezed in at the middle. And so the only benefit that we've seen of inflation is that the utility rates are also going up. So what was a 10-cent PPA may now be a 12-cent PPA. And so we balance it out that way because the utility rate has gone from 11 cents to 15 cents or something like that. So, you know, all of the hyperinflation that we've seen, and it's starting to slow down, fingers crossed, but, you know, it's starting to slow down a little bit. It's affecting everything kind of equally. And so we're able to maintain the status quo. I think the IRA is really going to just help us be more efficient at developing systems that add value to the customer. If I can put a system in a place where I have a 50% ITC that I can toss to the customer, their returns are going to be better. If we're going to finance it under a PPA, we can give a better price because we know that our developer fees are going to be protected at the same rates or even a little bit higher because the investors are going to value these systems higher with a 50% ITC than with a 30% ITC. So now maybe I can pass 25% savings to a customer. You know, things that we weren't able to do previously. This opens the door for it.
Gotcha. Thanks.
Any other questions from Micah? All right. Listen, I have a couple of questions real quick. So Micah, this 5 megawatt capacity seems to be the kind of the showstopper for ones. If you had to have a bigger system, you cannot get on the adders. So does that kind of rule out other forms of renewable generation? You mentioned wind. You know, what about small nuclear? I mean, it's not renewable, but it is green. Are they candidates for this at all?
So this is a really good question. I don't think so. But what I think they're trying to do, and I wish that I had a chart for this, because what it looks like is it's like the price of solar compared to the size of solar looks like this, right? And so there's an inflection point where systems above a certain size generally are cheaper than others and can withstand just having a 30% ITC. I think 5 megawatts AC is what they put a line in the sand and said, we need something, and we want it to be a relatively even number. So 5 is where we're going to be at, because if we go with 10, that's just too big. And if we go with 1, that's too small. Don't quote me on that. That I have no idea what the decision making was on that. But when we deal with something that's 5 megawatts AC, I think we should also be pretty aware of the fact that that's not the be all end all of the size. When we're dealing with solar, there's an AC to DC ratio. And a lot of the times it's 1 and a quarter or 1 and a third. So you take that 5 megawatts AC and you multiply that by 1.25, and that's your DC size, which is, that's going to dictate the number of the amount of panels you're going to have. It's going to dictate the amount of production you get, all that stuff. And so this is just the size of your inverters. And so 5 megawatts AC is really allowing us to get up as high as, 6.5 or 7 megawatts DC, which, I mean, that covers a lot of the commercial sector. Most of the volume is sub 5 megawatts in the commercial and obviously the residential space, but they're not really taken into account here. But what it really feels like the incentive is more community solar. Community solar, if anybody's not aware of it, is a central system that has subscribers rather than a single customer on the system. And so you may have a 5 megawatt system with hundreds of residential subscribers who live in apartment complexes or things like that, where they can't access solar on their own. And so I think a big part of this is to incentivize more community solar, give more access to green energy to the people, and to make it easier for businesses, especially small businesses, to have some relief on electric bills, especially with the hyperinflation. Places like Massachusetts, a jump as big as they're going to deal with could put a small business out of business. And so stuff like this incentivizes this development and allows us to be more efficient on the way we're doing things. And so I hear what you're saying about other asset types. Given the cost to production, the cost to capacity factor of these other asset types, it's less of an economic driver. When a nuclear power plant has 100% capacity factor versus the 16% maybe of the solar project in the same area, it makes a big difference to have that extra tax credit.
Okay, then again, a segue to, if solar is somewhat preferred because of its characteristics, you think of all the adders that could come in for an energy community or tribal lands. Does it also promote multiple community solar projects? In other words, the 5 megawatt AC could be operated by so many different, 5 megawatt AC company capacity could be implemented by company A, company B, company C that could fill the gap in and take advantage of all these adders that come on. Is that one of the motivations?
That's absolutely the goal. That is absolutely the goal. So I talked about Illinois. We had one of the juiciest community solar rec incentives in 2017, so much so that they had to run a lottery for who received those incentives. And you had companies that had land rights on tons of different pieces of land, knowing that if they won even one or two of those pieces of land's worth of community solar, that everything was covered. And so you ended up with, there's probably about 15 or 20 companies that operate or who own all of the community solar in Illinois because they've bought up projects that won those recs at such high values. But yeah, that's exactly what we want. We want more diversity in those assets. We want to build that market. We want the competition, because now they're going to be required to offer more savings to their customers. All of that stuff. It's all really, really important. So these are good things, and especially in areas where it's heavily serviced by fossil fuel generation. They want these community solar systems so that they can say, hey, look, we are generating for this many residential customers right here in our state.
Hey, listen, sorry guys for taking you into overtime, but it was really very interesting discussion. Again, on behalf of ESE, Micah, thank you very much for this very first seminar for the spring session. It's the very first day of classes. What a way to start. And
absolutely, this was great.
So our next seminar is on February 13th. So it's 3 weeks from now. We'll have one of my colleagues from TVA. She's a director for field services for Tennessee Valley Authority. About her talk will be about how to pivot. TVA is one of the oldest utilities, and how they're trending towards green is an interesting story in itself. So that's on February 13th. And so I look forward to welcoming you all another 3 weeks. Micah, thank you very much for this seminar. And as I said, this will be on our ESE YouTube channel shortly. So I think once it's there, Susan will send you a note, and so you'll be able to share it with your folks. Well, thank you all, and good afternoon, good evening, and look forward to seeing you very soon. Thank you.
Thank you.
Thanks, guys.
Thanks a lot, Dr. Sussman.
Thanks, everyone.
Okay, Susan, you there? Oh, you're
Yep,
there.
yep, I'm still here.
Oh,
Got to start
didn't-
moving
I
people soon.
yeah. It stops recording when we leave, or how does that work?
You have to stop recording it.
Oh, I can stop recording. Stop recording. There we go.
Here, actually, I can